In this presentation, we will take a look at inventories related to a sole proprietorship reported on a Schedule C. We're focusing in terms of our income tax equation up in line 1. So we're up in line 1. However, we note that this will be supported by a Schedule C, and the Schedule C will in essence have an income statement which will have revenue and expenses related to it. Note too that we're considering inventory here, and inventory is typically something that's going to be on the balance sheet. However, when we think about the Schedule C, we don't have a balance sheet. We're just reporting the income statement side on the Schedule C of the sole proprietorship. Why is inventory important then? Because it's going to be a major part, or it's related to the income statement account of the cost of goods sold, and it's going to be within the calculation of the cost of goods sold, which has the beginning inventory plus purchases minus the ending inventory. Inventory is also something that could affect whether or not we need to use an accrual method and can't use a cash method. Sometimes inventory is one of those factors where the IRS then would like to see an accrual method rather than a cash method if the inventory is significant. We're focusing here in terms of our 1040 on line 7A with the other income, that being supported by the Schedule C. The Schedule C number here on line 3 supported by the actual Schedule C. Inventories. Generally, if you produce, purchase, or sell merchandise in your business, you must keep an inventory and use an accrual method for purchases and sales of merchandise. So this is going to be when, usually, as we saw in prior presentations, when looking at the method of accounting, we said for a sole proprietorship, you kind of have an option of the cash method or the accrual method or some kind of component even of them as long as you are consistent. However, if we have a significant amount of inventory with relation to the purchases and sales of merchandise, the IRS wants to see an accrual method. And note, part of the reason because of that, you can think of that, this is my justification of why the IRS would want this, and that would be because now when we have the purchase of inventory, it's significantly different time period as to when the inventory is going to be then generated sales and when the cost of goods sold will be related to it. In other words, if I wanted to distort basically the income statement and I had a lot of inventory that I could purchase the inventory on a cash method, and then I would be able to, on a cash method, deduct in this year, even though I'm not going to sell the inventory possibly till the next year or even more years out into the future. And so the IRS, there's a distortion then in terms of when that cost of goods sold would be recognized on a cash basis and when the actual sale of the inventory happens. Therefore, they would like to see an accrual method which should match those things up in a more proper fashion, matching up the actual revenue and expenses in the same time period. Exception for small business taxpayers. If you are a small business taxpayer, you can choose not to keep an inventory, but you must still use a method of accounting for inventory that clearly reflects income. If you choose not to keep an inventory, you won't be treated as failing to clearly reflect income if your method of accounting for inventory treats inventory as non-incidental materials or supplies or conforms to your financial accounting treatment of inventory. If however, you choose to keep an inventory, you generally must use an accrual method of accounting and value the inventory each year to determine your cost of goods sold in Part 3 of the Schedule C. Small business taxpayer. You qualify as a small business taxpayer if you A, have average annual gross receipts of $25 million or less for the 3 prior tax years, and B, are not a tax shelter as defined in Section 448D3. If your business has not been in existence for all of the 3 tax year period used in figuring average gross receipts, base your average on the period it has existed. And if your business has a predecessor entity, include the gross receipts of the predecessor entity for the 3 tax year period when figuring average gross receipts. So you're looking at the 3 prior years, in other words, and then you got the question of the exception. Well, what if I wasn't in business for 3 years? Well, if you were only in business for 2 years, then you're not going to take the average of 3 years. You'd take the average of basically the years that you would be in business, the 2 years. If your business or predecessor entity had short tax years for any of the 3 tax year period, annualize your business gross receipts for the short tax years that are part of the 3 tax year period. See publication 538 for more information. So then the next question would be, well, what if I had 2.5 years because I had a half year when I first started. It wasn't a full 3 years. Then it wouldn't make sense to average over a 3-year time period because I only had a partial year. Then you'd basically have to figure out the partial year in order to figure the proper average. And to see more detail on that, you can see that on publication 538, can be found on the IRS website at irs.gov.